good morning. This is Mr. Not Advice. This is my weekend update. It is Saturday, February 7th, 2026. As always, this is for education and information purposes only. Maybe entertainment. Yeah. All right. So, crazy week this week. And I bet you didn't know that the Dow Jones Industrial Average topped 50,000 this week. Who cares? And yes, we had the Super Bowl this weekend. Also, don't care because the best team's not in it. Philadelphia Eagles. And I guess the Olympics started yesterday, and it didn't take long for the U.S. ski team to immediately start with their shit comments about not being proud of the U.S. Whatever. I mean, it's just retarded. Anyway, let's take a look at Goldman. All my charts are courtesy of Zero Hedge, and I apologize. I have a cat here. Trying to eat my mouse. Okay, so I like Goldman's comment this week, which was this week's tape can only be categorized as Adult Swim. I would absolutely agree with that. One of the interesting things was while we had um, volatility moved up in most asset classes, bonds and the broad equity market really didn't see an explosion in volatility. But you'd figure after such a big shit show in both, well, I guess in all big tech and precious metals and Bitcoin, uh, there's probably going to be obviously a rise in volatility. So let's look at this first chart here. We had the Dow and the small caps ending the week considerably higher. As I mentioned, the Dow hit a record high. NASDAQ was obviously the week's laggard with the whole software as a service apocalypse, which I do not think is over, by the way. And I'm going to get into that in a little bit later. But we did have yesterday afternoon a late day panic buying, and that was probably driven by Fed's Daily said that there were one or two more rate cuts might be needed. So that actually lifted the S&P 500 to unchanged for the week, which when you think about it, that's pretty crazy with all the volatility that was in the market and the sharp drop in equity prices during the week. The S&P bounced almost perfectly off its 100-day moving average, and it even was able to accelerate back above its 50-day moving average. Do I think the pain is over? Uh, I do think, well, let me get to that later because I think some of it's going to depend upon on how much this software as a service fear uh, bleeds into the rest of the market. So let's take a look at some other charts before we get into that discussion. The NASDAQ remains well below its 100-day moving average, even though it had a nice bounce yesterday. Additionally, we had Amazon and Google weighing down mega cap tech, but broadly, there were notable reversals in performance with 75% of the SPX trading green yesterday. Standouts on the leaderboard were Bitcoin sensitive stocks were up 17%. Non-profitable tech was up plus 8.1. That helped EOSE. Most shorted up plus 7.8. That helped EOSE. And retail favorites were up plus 5.9%. Hedge fund flows were pretty strong yesterday with their buy skew hitting plus 25% yesterday morning, but then leveled off to 2% towards the end of the day. The highest over the last 4 weeks for hedge fund buy skew was 5.59. So you can see it was really a big, strong buying day. It was also worth noting that today is the first WIT day this week that long onlys also had a buy skew. So, but if you look underneath the hood, underneath the indexes, there was quite a bit of pain in some very large companies. Nvidia shares did jump 7.8%, but Stellantis fell 24%, which was the most on record. It's funny when our members said, "Who the hell would buy uh, a Chrysler car?" But anyway, they dropped 24%. Molina shares sunk 26%. I think there might be under investigation. I have to look again. Amazon shares posted a 12% weekly decline, which is the most since 2022. And then the iShares software ETF was down 8.7% and the worst weekly drop since April. There was a massive outperformance of value over growth this week, but I think a lot of that had to do with the significant underperformance of software as a service. Said this a couple times this week in my end of the day report that I think the focus is going to start shifting towards those companies that are able to show that implementation of the AI stack is going to have faster benefits, either through increased efficiencies, which would lead to lower cost, higher productivity, or directly to the bottom line in terms of their labor costs. So this shift, while it was, I think, largely driven this week due to the sell-off in software as a service companies, I think this is a trend that's going to continue actually. All right. We had the Mag 7 massively underperform the S&P 493. Of course, we did have them reporting this week. And again, this makes sense if you're looking at this rotation out of the concentration of being in just AI. And the Mag 7 tends to be and is, they have the high beta names. So they're going to be more sensitive and more volatile uh, to the overall market when we have fast moves. Yes? Well, we were able to get a couple trades off this week, and I think we did okay. Momentum ended this week flat, the momentum basket, although it did rebound very strongly from Tuesday's puke. Um, I don't know if, I had some members asking, if do we think this is over? I don't know if it's over quite yet. I typically look at these events as lasting 2 to 3 days. And then you get a rally, a sharp rally, and then there'll be another ripple of fear and works itself through the market. I don't know when that's going to happen, but I do believe it's going to happen. So, according to Goldman, investors are not liquidating equities to holding cash, though. They are just buying different equities, stocks with little to no connection to AI. So there's more of that rotation as hot money or investors are seeking more stability and less volatility in their equity exposure. But at this point, investors are not wanting to exit the market. So one of the things that rocked the software as a service market was Anthropic's comment about, he said software engineering will be completely obsolete in 6 to 12 months. Well, that's a little bit self-serving because they are the leader or one of the leaders in creating this next layer of AI agent. For example, I think it was JP Morgan or Goldman Sachs had hired Anthropic 6 months ago to go in and design and then deploy a new layer of AI agent in their back office and compliance departments. And I think we're going to see more of that, but I don't know if software engineers will be completely obsolete in 6 to 12 months. Uh, I think it will take a little bit longer. Okay, so let's see. What do we have here? Looking at this chart, we've got today was the biggest short squeeze since Trump Taco Liberation Day and the second biggest since November of 2022. That helped a lot of the small caps, particularly EOSE. And so I don't believe, and once we get to the Russell chart, you'll see why. I don't think this rally on Friday is something to get overly excited about. I'm not at all saying that the quote unquote bottom is in, because it wasn't much of a bottom, quite frankly. We're still trading, other than the Qs, we're still trading very near all-time highs. So if people were freaking out over this week's market, I can't imagine what will happen if and when we get a prolonged downturn. I think the speed of the market really is what whipped people around. And I think that this was much needed. I've been talking to members this week and reminding them that we had leverage in the 95th percentile. We had, for financial advisors, assets under management as a percent of assets under management, we had cash positions at 3%. The commodities market was, particularly metals market, which is highly leveraged. Binance, up until this week, was giving 1,000 to 1 leverage on silver. And I think that a lot of when you see that near the top of the market, it sets up for a cascade event where you have a shit ton of margin calls. And then it becomes, well, we don't just sell the asset for that is margined. We've got to sell to raise capital to meet margin calls. So I think that's what was happening this week. I think it was concentrated in Bitcoin, Ethereum, as well as in silver and gold. I think that bled out to the broader market. And I also think the market was looking for a reason to sell off and take some risk off the table. Remember last weekend's report, I covered that the bull bear sentiment index, no matter who you look at as a provider, was in 96, 97. And so there was a tremendous amount of complacency out there. Also, if you remember me saying for the past week and a half that dealers were largely unhedged to the downside. It was a call party. So it was the perfect storm, or pretty close to it, in terms of why there was such volatility and strong strength and speed to the downside. But when you step back and you look at a longer term chart, I really don't think that I don't think we're out of the woods yet. Let's put it that way. And finally, we have here, this is the NASDAQ seasonal flow of funds. All right. So we're going to see an increase in the flow of funds on average since 1985. And we're going to get that through February 14th through the end of next week. And then from that point forward, we'll experience, a small drop. Okay. This is not, you got to understand here, this is like 1.5%. Okay. Um, and then this is all the way through. Oh, this is still March 15th. So it's the good news is that outside of this mini little spike here, uh, we're going to see a pretty steady level of funds flow on a historical basis into the market. So according to Goldman Sachs Flow of Funds gurus, this is what was behind the headline. So systematics, those funds that are quant funds, their supply was unleashed by index trigger levels breached. Hedge fund positioning is getting cleaner, but the road ahead continues to be bumpy. Seasonality. Remember, February historically is a weaker month for both the S&P and NASDAQ, and it's actually the second weakest month for the year. Also adding to the volatility there was whippy price action as more thematic trading started to broaden out. What does that mean? Well, we had been in a market where the indexes were rising in unison. It was a bull market, right? Now what we're starting to see is specific sectors, okay, start to separate from the rest of the market. That will then, and that's why I made the comment about this is becoming a stock pickers market, right? And so that could and probably will continue as investors try to figure out what the hell is going on with AI, who the leaders are. As I said earlier in this conversation, certainly software as a service is going to remain in focused. And by the way, the bottom's not in for that. And I'll go through that. But I think we're going to continue to see a rotation of capital where the net result is going to be everything's not going to go up the same. We've been in a period of the market for so long where the S&P, the NASDAQ, and the Russell pretty much trended at the same time. And I think we're going to start seeing not where an index moves inversely to the other ones, but that the performance of each index is not going to be as correlated as it has been in the most recent past. So one of the most asked question about flows today is a global CTA positioning. Right now, it's sitting below the 90th percentile on a 5-year look back. Look, that's still deep into the market. So there hasn't been a tremendous amount of selling by CTAs. And in fact, even though CTAs have sold over 6 billion in US equity since the start of the year, their positioning still sits in 70th in terms of their percentile range on both the 1 and 5 year look back. Over the next week, whether the tape is flat, up, or down, CTAs are sellers. Okay. On a flat tape, their sellers are 19.5 billion. On an up tape, 8.7 billion. And then a down tape, it gets ugly, 58 billion. Okay. There over the next month, there's only one scenario where they will be net buyers. So on a flat tape, they're going to sell 21 billion of equities. On a down tape, they're going to be selling 213 billion of equities. But on an up tape, they are going to buy 21 billion, almost 21 billion of equities. Looking at short-term thresholds in the S&P, uh, right now, if we break 6707, there's probably going to be another 80 billion of supply by CTAs to come in and sell over the next 1 month. The Nasdaq medium term threshold is very close. However, the majority of CTA supply is concentrated to the S&P 500. Okay, as we've been talking about, or I've been talking about, liquidity is always important. We've had liquidity quickly deteriorated this week. You had S&P top of the book liquidity. And when I talk about top of the book liquidity, that means the best bids and the best ask, the most liquid, because that's where the big traders are able to find liquidity in terms, so they're able to get orders executed. So the top of the book liquidity for the S&P 500 has decreased slightly, 4 million, but the year-to-date average is 13.69 million. So it's tighter at the top, and the inability for large dealers to transfer risk quickly because there are not liquid bid and asks of size is going to lend to a choppier market environment. Looking at dealer gamma, there was a long gamma pocket that prevented the market from breaching the 7,000 level this week. Remember, if dealers are long gamma, they're going to sell rallies and buy dips. But this week's sell-off has flipped dealers to flat to short gamma positioning right around where the current level of the market closed. Looking forward, dealers are expected to get longer on rallies and shorter on sell-offs. So rallies will be sold, sell-offs will also be sold. Although this does not mean that dealers are being position max short. But when you couple that with the low liquidity at the top of the book, this is going to make market moves both up and down. It's going to make them more violent. So volatility is not over yet. If we look at the breadth of the market, we had 137 more companies in S&P were down on the day yesterday than up. But the spread is going to continue to widen out as investors trade thematically, becoming what? A stock picker's market. But right now, these levels are not really overly concerning. So last year we had retail driving the market. They came in and bought all the dips. However, this year they have been less willing to buy the dips, as seen by the latest 2-day net imbalance of retail at a 690 million to sell, but they remain active. Retail favorites like crypto and crypto linked stocks have been hit the hardest this year, and a rotation out of US equities, if it occurs, is going to mark a notable departure from the path of last year's trading. I don't see that happening, not in size, not yet. Further supporting this rotation or this growing focus on thematic trades, Goldman's flow desk saw that ETFs uh, were 40% of the tape this past week, which drives home the point that they're using ETFs to choose which parts of the economy they want to invest in. Momentum got crushed this week with Goldman's momentum basket being down almost 8.5% over the last 3 days. For us, that's why we've largely stayed at the sidelines. I mean, the last trade we took was a short in the Great Orange Winds Company, Donald J. Trump, which we did okay in. Our returns have been somewhat, well, I can't say that. We had a 100% return in Coke this week. So, in what, 3 days? But we're going to see probably more money going into ETFs. We're going to probably see which are investors choosing which parts of the economy, right? That thematic, theme-based investing. And that means we'll probably see funds continue to flow out of active mutual funds. And then finally, we have here the Goldman Sachs Panic Index, which was 9.22 based on the 1-month S&P implied volatility. And putting that in perspective, investors are really still not far off from max fear. While we had max bullishness in terms of positioning and margin, and we had this last week in terms of sentiment, that has flipped very fast. Just saw this on Twitter and I wanted to he's already gotten called out on it, but I saw this on Twitter, and just because somebody has a name that you know and they have a nice picture and all that shit doesn't mean that they don't lie. So this guy, we know who he is, Robert Kiyosaki, rich dad, poor dad guy. So he said that he stopped buying Bitcoin at 6,000, but then last July he said that he bought at 117,000. So people have been calling him out for being a big fat liar, which they should call him out for being a big fat liar. Also, he said he stopped buying silver at 60, and yet he stepped back in the market last month and also said that he bought at 100 and I think 1,712. So, all right, let's take a look at the overall market. We have the S&P 500. Here we go. S&P 500. Yeah, I would say this is more than a 50% retrace. Again, we blasted above the 50-day moving average. If we do get a retrace, it's going to be on Monday. I'm talking about it should hold because both the midpoint of Friday's candle as well as the 50-day is going to be very strong technical levels. We remain within shooting distance, shouting distance, whatever the phrase is, of all-time highs at 7,000. I have no desire to go long the S&P 500 or any of its levered products until we break above $7,000 a share, 7,002, let's call it. Looking at the NASDAQ market, a little bit worse. But if you drill out here, you can very easily see that the NASDAQ, it remains stuck in this channel. And until we break through this double top up here, I also don't have any desire. There's no need for me to be a hero here and get in early. We have a double top on the NASDAQ here at 26,000-ish, right? I am not going to go long down here in the middle of a battle zone. So that would be breaking rule number 1. Right below the 50-day moving average, that would be breaking rule number 2. And then common sense tells me we've been trading this freaking channel since, I don't know, back in September. It's got to resolve itself. It's tried twice now to the top side. It's tried once to the downside, okay? I'm talking about the extensions beyond these support levels and resistance levels. I'll let the market do the work for me. I'll let everyone else risk their capital and try to be geniuses and call this bottom. Once it breaks through here, though, I think we could get some strong momentum. And a lot of it's going to depend upon what part or time in the calendar we are, too. I'm not going to get long the S&P 500, nor am I going to get long the NASDAQ market. Let's take a look at the Russell market. I might get long the Russell market. Why? Well, the Russell market, going back to September, is well above its September lows. It has broken through each of the topside resistance levels here and here. And in my mind, this is merely a retrace against the previous breakout level. So the question is, where will I get long the Russell 2000? Well, that depends, because I'm not going to get long off of this reversal here, but I am looking, and then remember, I'm going to use a leverage product for this. I am looking maybe at the 2685, but that only gives me 2% to the top side, okay? But if I were to do that, it's going to be a smaller position, so not 4%. it'll be a smaller position than average. And also, I want to see how this resolves itself. I don't think the volatility is done in the market, by the way. I don't think Friday was the all clear sign and, happy days are here again. I think there's going to be continued volatility because I don't think the whole issue about software as a service, and finally, why don't we get into that? People are trying to figure out where the value is going to accrue in the software stack. Is it lie in agents? Does it lie in LLM orchestration that spans infrastructure and platform and application layers? Once that's figured out, I think we're going to start seeing a demarcation between software as a service providers to those that are already ahead of the game will succeed, and those that are playing catch up with AI, they're just starting to implement at scale. I think they're going to be left behind. So, looking at specifics, so this is coming out of Goldman Sachs. What we got here, technology research team. Okay, and I'll just read it directly, again, courtesy of Zero Hedge. So their team states that in apps, value accrues in the orchestration layer, but is evolving from software as a service to software as a service plus AI. That's a process with some companies further ahead. For IaaS, or infrastructure as a service providers, they're going to need to continue to diversify across compute use cases. And then platform as a service functionality and gross margin improvement is going to be key. Goldman Sachs tech team then points out a couple of factors or events that they will look for that will give them confidence that the software as a service is truly bottomed, and we will start to see that sector enter a growth phase. The ones I found interesting were they're going to look for more customer examples of AI projects shifting to packaged software offerings from bespoke custom builds. So instead of, let's say, Goldman Sachs hiring Anthropic for 6 months to build a custom platform for their back office and compliance department, it'll seem more off the shelf offerings for AI projects and packaged software offerings that the industries that they're focused on can buy. Another data point that they point out that I agree with is as the push for adoption starts converting to monetization, okay, we're going to start seeing some evidence of pricing power for the leading software as a service providers. Want an example of that? You look at Palantir's approach 18 to 24 months ago, where they were first focused on enabling enterprises and then encouraging adoption to deliver value, and then they monetized after this. Also, another data point or an event that they're going to look for is AI native company or an LLM platform acquiring a software as a service business. That would be evidence that perhaps the M&A side of that would show that the M&A cycle in software as a service had started. Their conclusion is that it's going to take 2 to 3 quarters of stable fundamentals for investor sentiment to improve. And even if that were to happen, the bear case, it could just get pushed out to future years. So people calling that, Friday this week was the bottom, they're smoking weed. Remember, it's a technical bounce. It was oversold. Okay. It was long due. And the market was always looking for a reason to go in a direction. It's not as if the market is saying that software as a service is completely dead. And despite what Anthropic says, okay, or the Anthropic CEO. So that also means that Friday's bounce doesn't mean that software as a service is fixed either. So let's keep that in mind as people try to bottom fish. And in fact, on the IGV, yes, we saw massive inflows in the IGV. Does this look to you like a bottom? I don't think so. Let's take a look. I think I was covering the Russell here. Other notables, PCT. We are in PCT, and we were down 40% on this drop. We had very good entry on it, so I'm still holding it. I think I'm down 24% on it. And if momentum stocks get a bid, this PCT, I think, will do very well. If I get stopped out, I get stopped out. It was able to recover the 50-day moving average, which is an important level because remember, these technical levels are used by bots and algos. Let's take a look at NVIDIA. NVIDIA was also able to recapture its 50-day moving average. But as you zoom out, you can see that this battle zone here, we're smack dab in the middle of it. So until NVIDIA breaks 200, I have nothing to get excited about within NVIDIA. Some of the other stocks that we use as bellwethers, Meta continues to sell off and now has sold off all of its post earnings gain. Technically, it's got two very important support levels here, both at the point of control as well as the 50-day moving average. So this very well could be a bounce level, but look what's right above the 200-day moving average. So this is going to be very difficult again unless and until we get more clarity in the tech sector on the AI spend and how it's going to drive profits to the bottom line, either through efficiency or monetization. I think we're going to continue to see choppiness in the largest AI names. In venture, uh, purely a momentum bounce here. I would not be getting long in venture on this humongous candle here. Okay. We are very near the 52-week low. And I actually, unfortunately, think that unless they announce another order, I think Inventure is going to continue to go down and trade probably with a one handle, so below $2. I don't think that that will be permanent as long as in the industry starts adopting their cooling technology more. Okay. We had one of my members who's pretty high up in the tech stack chain as his real life job was commenting. He and I were having this debate about INV and what the risks were. And we both agreed that one of the risks is purely at implementation. If you're a big tech company, chip manufacturer, are you going to be willing to try out new novel technology no matter what the efficiency gains are or the power efficiency gains are because it cools chips better and cheaper? Because if it doesn't work, you put it into your manufacturing production process and it doesn't work, you have to look at I think the companies would wisely look at what is the risk versus the benefit. And it's going to take a company coming in and just saying, we're going to take the risk. And I don't see that happening with a huge company because they're happy to continue to muddle along, making the profits they make without and let some other company test this new innovative technology. So I'm not saying INV is dead. I'm just saying the path to higher stock prices is going to be entirely driven by adoption and orders. And if you're sitting there thinking a large chip manufacturer is going to put INV into their tech stack, I don't think you're being realistic with yourself. This is going to take time. Of course, they could announce Monday that they have a deal with Intel or with I don't think that's going to happen though. There's just too much risk to a company like Intel, right? It's looking at Google. Google had good earnings. Google remains king of the Mag 7. Look at this, right in the middle, smack dab in the middle of the battle zone. But what's some good news? Well, first good news is it was able to bounce and hold above the 50-day. Also, yesterday's action, we just saw weakness in the Mag 7, okay, which I think was entirely rotation, as I covered earlier in this discussion. It held a 50% retracement. So where am I looking long? Oh, 350, get above 349, and then I'll be much more excited to get into it. While we're at it, Amazon announced that they were going to spend $200 billion in CapEx, and the market did not like that. So how low do I think Amazon can go? Well, 200 is a natural number for it to bounce. But if I drill out here on the weekly chart, here we go. Okay. So on the weekly chart, if it fails 200, then the next stop is going to be 160 to 150. Let's take a look at EOSE. Redacted, there's been a lot of gnashing of teeth and moaning this week because they don't have any news. And I get that. You want some clarification? I'd like some clarification. in what the hell's going on. But I think a lot of this selling was not organic to the company because there's been no new news. I don't see volumes to the level where somebody knows something. Okay. And now we are back down at the bottom end of this massive battle zone, right? So, will I buy EOSE? Yeah, I might. I'm looking at it on, let's see here, on Monday on this reversal. Absolutely. But it will not be a 4% position size. Okay. But this has been in the past, this has been a level where EOSE has bounced. Also, if you look further back here, okay, after this break, this was a consolidation area too. While it didn't last a long time, I do think that from between here and all the way down to maybe 950 where the 980 where the 200-day moving average, I think it's going to find support here. We are on the clock for earnings, and I do what we got earnings coming up in the next week or two, and so that'll be a added little bit of heightened risk, but it also is probably going to add IV rise into it, so implied volatility rise. So looking at NVX technical bounce, this thing is it's a sick company. I think this thing trades below a 5 handle this year. I think it's gonna happen here in either the first or second quarter as this stock continues to get driven to pound town. So, I feel very badly for long-term NVX investors because they lost money and continue to lose money. At the same time, I have been hammering the table, as has Mr. Ray's, about when you look at a company, at some point, you've got to expect the company to deliver on the fireside chats that they have. And so far, this company has not done that in the least bit, right? Who, by a show of hands, expects NVX to talk again about the myriad number of samples that they've sent out? Okay. I think NVX is a dead company. I don't see them how long is it going to take for these companies to go through their qualification process and procedures, right? I'd love to be proven wrong. Prove me wrong. Let's look at gold and silver. Is it time to get back into gold and silver? Absolutely not. Until we get back above this $100 level in silver, I want nothing to do with it. Now, you can sit here and say, well, yeah, that's a 33% rise from the current level. Go for it. Risk is high. Risk is extremely high in this. And so, oh, and also you have Chinese Lunar New Year for a week. So the Chinese markets are shut down. So you might get a lift in price because a lot of the selling that was happening last week, I think, was due to the fact that Chinese Lunar New Year starts this week. And the Chinese do not traditionally want to be long their silver and gold going into that long holiday. Looking at gold, struggling with that 5,000 level. Where will I get long? Well, right here. The risk is, though, that this is right at about the 50% level of this candle, a little bit higher, but I don't think the story is over for gold. Right now, we are stuck in this battle zone between 4671 and 5100. Till we break out of one of these areas, I think it'd be very challenging or dangerous to make a directional bet on gold. Since uh, we've got members that own it, Ethereum. Again, nothing more than a technical bounce. I think that Tom Lee has, in my mind, lost all credibility. He continues to pipe off about how Bitcoin's every day he put out a price low, it was wrong. 2,700, 2,600, 2,400. Then it went below 2,000. At some point, he's going to be right. Okay. He's looking for a super cycle in Ethereum. And what I don't understand about these guys who call for these massive price targets is why don't they look at the daily and weekly chart before they make those predictions? At least wait till the trend is in your favor and then make the prediction. But Bitcoin has some serious overhead resistance. Okay. Not only do we have this gap, not only do we have 2,500, right? We also have 3,000, which is the 50-day. Then we have the 200-day moving average. I mean, it's going to be very difficult and it's going to take a lot of capital flow back into Ethereum. I'm sorry, Ethereum, in order for this to have a chance, okay, at getting anywhere in close to recent highs over 4,000. Bitcoin, again, same thing. I think we've got massive overhead supply or overhead resistance at the point of control, as well as the 50-day. We have the 200-day sitting up here and the 100,000 number. And fairly soon here, we're going to see this 200-day continue to start to slope down too, which is not a technical look that bulls want to trade into. I'm talking about traders. We had a tremendous amount of margin selling going on in Bitcoin. When you're leveraged 5,000 to 1, that's going to happen. But do I think Bitcoin's dead? No. I think Bitcoin's going below 50,000. That's what I think. I've seen some calls down to 15. I'm not a Bitcoin expert. I'm just taking a sort of looking at the overall trend, taking in what the expectations are from the investment community, and the fact that there are still people that are calling for, well, Tom Lee was calling for what, 160 or 120,000 by the end of 2025. And I keep bringing him up because he is followed by a lot of investors, okay? And my point is, he doesn't have a fucking idea what's going on with Ethereum and Bitcoin. He just keeps throwing shit out there and getting invited on CNBC. Oil. Oil is putting in a pennant formation, and that tells me it's going to go up. And this is not something that Trump wants because oil, the rise price of oil is a rise in price in gasoline, and that's an immediate tax at the pump, and consumers do not like that. So what am I looking for this next week? Well, I wouldn't be surprised if we see sell off on Monday or Tuesday, as there is more selling in the software as a service, that would bleed out further into the rest of the market. I think there will continue to be, as I've been saying, this will become more and more a stock pickers market, as because the easy money of just buying an index and they all go up at the same time, that seems to be on pause right now. I do think that with the selling this past week, it does put the market in a much better position to launch into the next bull round. You can't launch into a bull round if everyone's long, everyone's leveraged, okay, and there's no cash on the sidelines. And so I think this is a very good for those that are looking a little bit longer term than a day, that now we have bled off some of that euphoria in the market. Certainly margin levels should come down and cash levels should rise. I love the fact, if this continues, this trend into more thematic investing, stock pickers market, I do very well in those markets. So I think it remains to be seen whether this is a temporary bottom. It might be for a day or two. The volatility remains high. I've went through that in terms of gamma positioning. So remember, what I'm doing is I will maintain position sizings that's smaller than normal, and I will be very selective on trades. Understand that I probably look at, like last week, I probably looked at over 25 different trades. And I think we took 3. So I'm much more picky in this environment. Look, when when the market is choppy like this, I look at it like the wind's at your face. There's no need to try to be a hero and put a tremendous amount at risk. Allow for conditions to get easier, right? More predictable, in trend. And that's when I size up. And there'll be plenty of time for that. My gosh, we're only exiting the first week of February here. So we've got a tremendous amount of the year left. We're not even halfway through the first quarter. I believe I got to update my model portfolio, but I believe largely due to my EOSE sales in the beginning of 2026, where I took about 40% of my capital off the table. I'm up, I think, close to 20% for 2025. So, my minimum target return every year is between 50 and 70%. So, I feel fine. I'll continue to take small shots in the market, but until we get out of this choppiness and mess, there's no need to try to be a hero and call bottoms in any of these assets, whether it's Bitcoin or silver, gold, or software as a service. Anyway, I hope you have a great weekend. I don't know who you're rooting for in the Super Bowl. I'm rooting against both of them. I probably won't even watch it for the most part. And I certainly am not going to watch the weirdo halftime show. But I hope you all spend it with friends and family. All right. Have a great weekend. I'll talk to you very, very soon.